Okay, let's unpack this. Remember the crypto winter of 2022, 2023. All those headlines.
Oh, yeah. Screaming about collapses, lost funds.
And just shattered trust, really. For a lot of people, it felt like the whole DeFi experiment was just crumbling.
It did. Looked pretty bleak.
Well, here's where it gets really interesting and maybe a bit surprising. Bitcoin lending, the thing that seemed to completely implode back then,
Uh-huh.
it's not just recovering, it's making a significant, and I'd argue maybe even more sophisticated, comeback in 2025.
What's truly fascinating here isn't just that it's back, but the evolution we've seen. Many people, and you can't blame them, assumed that DeFi and centralized crypto lending were just inherently flawed.
Beyond repair, yeah.
Right after those huge failures, the
Yeah.
scale of the losses, they thought the basic models are simply, unsustainable.
Makes sense.
But today, standing here in 2025, we're seeing a totally new landscape emerging. It kind of forces us to reevaluate our whole understanding of risk and trust and opportunity in crypto.
Yeah.
It's a completely different environment now,
Mm.
really forged in the fire of those past mistakes and driven by this demand that just, it wouldn't go away.
So the question is, has the industry finally grown up? Or are we just better at hiding the cracks this time?
That's the crux of it, isn't it?
Exactly. So today, we're taking a deep dive into your sources on Bitcoin lending's resurgence, lessons from collapse to 2025. Our mission, for you listening, is to understand exactly what went down during that last collapse.
The nitty-gritty.
Yeah, pin down why lending is back with such, surprising force. And most importantly, look at what fundamental structural changes have been put in place to stop history repeating itself.
Right.
We'll explore the new models, the risks that are still there, and maybe new ones too, and what all this means for you, whether you're a seasoned investor or just kind of watching Bitcoin's role in the wider financial world.
We're going to pull back the curtain on this. And as we navigate this complicated terrain, we'll be sorting through the evidence, looking for those aha moments, the insights that connect the dots between the failures back then and the innovations now.
Finding the signal in the noise.
Exactly. Our goal is to give you the tools, the knowledge, to figure out if these new models really offer a sustainable, a resilient path forward for crypto lending.
Or if we're just looking at another ticking time bomb.
Maybe, albeit one with a nicer casing this time, maybe a new fuse. It brings up that big question for all of us. Can crypto lending actually become a reliable, stable, transparent part of our financial system? Something that can handle the next market storm? Or is it just too volatile by its very nature for that kind of institutional trust?
That's exactly what we need to unravel today. Okay, so to really get where we are now, we have to look back. Let's cast our minds back to those pretty dark days of 2022 and 2023.
Tumultuous is putting it mildly.
It really felt like the sky was falling for a lot of folks in crypto. We saw these titans fall names everyone in the space knew, right? Celsius, BlockFi, Voyager, Genesis.
Handful names in crypto, yeah.
These weren't small players. They were managing billions in customer money. And then, boom! Seemed like overnight, billions in customer funds just vanished.
Right.
Locked up in bankruptcy courts.
Yeah, gone.
And it wasn't just the money, was it? It was trust. Fundamentally broken. People felt betrayed.
And rightly so.
Their savings, their investments, their belief in this whole new financial idea just evaporated. So for you, the listener, trying to make sense of it all, what exactly happened there? What caused that kind of widespread systemic failure?
Well, if we connect this to the bigger picture, these failures weren't really isolated incidents. It wasn't just bad luck or a few bad decisions.
Right.
They stemmed from really deep-seated systemic problems within those centralized crypto lending models that were so popular then. The main culprits, first off, incredibly poor, often just reckless risk management. And at the heart of that was this really opaque and, frankly, dangerous practice called rehypothecation.
Rehypothecation, let's break that down.
Yeah, it's critical. So imagine you deposit your Bitcoin with a platform. You expect them to lend it out under certain terms, maybe once to someone qualified.
Okay, makes sense.
Rehypothecation meant that platform would take your Bitcoin, lend it to person A, then take the collateral person A put up and lend that out to person B, and maybe even again.
Wow. So the same assets are backing multiple loans?
Exactly. Creating this tangled web of liabilities, often without customers fully knowing or explicitly agreeing to it. It's like your bank taking your deposited dollar and secretly lending that same dollar to 5 different people.
That sounds incredibly risky.
It was. And it led to this profound lack of transparency in how they managed their money, how they accounted for collateral. Plus, they were just deeply overleveraged.
Meaning they borrowed way too much?
Way too much against their assets and customer deposits. Made them incredibly fragile, super vulnerable to any market downturn. When the music stopped, well, there weren't enough chairs.
That explanation of rehypothecation, that really hits home. It's almost hard to believe they operated like that, like a shell game with people's money. Can you give us a bit more on Celsius? How did they specifically show this mismanagement? And what about those crazy high yields they promised? Where did that lead?
Oh, Celsius was definitely the poster child for these problems. They promised these incredibly tempting yields, right? Sometimes 8–10% on Bitcoin or Ether, maybe even higher, like 15% plus on stablecoins.
Sounds too good to be true.
It basically was. For many retail investors, it was irresistible. Seemed like easy money, making your crypto work for you.
Yeah.
But to generate those high and ultimately unsustainable returns, Celsius got into really aggressive, super risky lending strategies. Their whole model relied heavily on that rehypothecation we talked about.
So they were taking customer crypto.
Taking Bitcoin, Ethereum, other assets, lending them out, borrowing against that collateral, then relending the same assets, sometimes multiple times over, across all sorts of DeFi protocols, other platforms.
A house of cards, essentially.
Pretty much. An incredibly complex, fragile web of interconnected debt, often using assets that weren't even liquid or were stuck in experimental DeFi stuff.
So when the market turned...
Exactly. When the crypto market took that big hit in early 2022, the value of their collateral just plummeted. Their leveraged positions blew up. They couldn't meet withdrawals.
Which led to the infamous freeze.
Yep, freezing withdrawals in June 2022. A desperate move to stop a bank run, but the damage was done. They filed for bankruptcy soon after. That promise of sky-high yields, built on shaky, poorly managed collateral and just extreme risk-taking, it collapsed spectacularly.
And Celsius wasn't alone. We saw this awful ripple effect, this contagion that just spread like wildfire. Genesis's bankruptcy is another huge example of how linked everything was, wasn't it?
Exactly. Genesis Global Capital was massive. A huge institutional lending arm, really key in the wholesale crypto market, kind of bridging institutional money and DeFi.
Right.
Its collapse in January 2023 was a direct, brutal result of this interconnectedness. People call it the FTX contagion, but it really started even earlier with Terra Luna imploding.
Ah, right. 3C was involved too.
Hugely. Genesis had massive exposure to Three Arrows Capital 3AC, which defaulted on over $2.3 billion in loans, and then significant exposure to FTX itself when it collapsed.
Double whammy.
Totally. When these giants failed, Genesis's balance sheet was just wrecked.
Yeah.
Billions in loans they couldn't get back, and that created this devastating domino effect.
How so?
Well, Genesis couldn't repay its creditors, including its parent company, Digital Currency Group, DCG, other institutions, platforms serving retail customers that sent shockwaves everywhere.
So platforms that relied on Genesis got hit too.
Absolutely. Platforms that had lent to Genesis or needed its liquidity suddenly faced huge pressure. Led to more insolvencies, more withdrawal freezes. It just starkly showed how intertwined everything was. The failure of one key player, especially one central to liquidity, could just rapidly take down others, amplify the whole crisis.
And showed the systemic risk that had built up without anyone really checking it.
Precisely. Unchecked.
So it really wasn't just about a few bad investments here and there. It was the fundamental structure, these systemic flaws that caused the whole market chaos.
Right. Precisely. It wasn't just picking the wrong horse or a couple of bad bets. The basic mechanics, the underlying risk setup of how these platforms work were deeply, dangerously flawed.
Like the loan-to-value ratios you mentioned.
Yeah, consider the loan-to-value, the LTVs that were common back then. We often saw platforms offering or taking LTVs hitting really risky levels, 80%, even 90%.
So borrow $90 against $100 of collateral.
Exactly. Which leaves an incredibly thin buffer against price swings.
Yeah.
And Bitcoin, as we know, can swing wildly. So a relatively small market dip, say 15–20%, could instantly trigger massive liquidation.
Selling off the collateral.
Right. And if that happened fast and big, it overwhelmed their systems, flooded the market with sell orders, pushed prices down even more, and left the platforms without enough collateral to cover their debts.
A death spiral.
Pretty much.
Yeah.
This systemic lack of strong risk controls, combined with that whole industry attitude of move fast and break things, prioritizing growth over safety, it just proved catastrophic.
And no real rules to stop them?
Critically, yes.
Sure.
The absence of clear, comprehensive regulation let these risky practices just flourish unchecked. No accountability, no standard best practices until it was way too late.
It's almost hard to really grasp the scale of that collapse without, like, a visual. If we had a chart showing Bitcoin lending TVL, total value locked from, say, 2021 through 2025,
Oh, you see it.
you'd see this dramatic, almost cliff-like crash during 2022-2023. It would be such a stark reminder, putting the sheer scale of the money wiped out, the loss of confidence, into painful perspective.
And that visual would really underscore the impact, not just the money leaving, but the depth of the distrust that just settled over the whole market.
Yeah.
It'd show how fast billions in perceived value just evaporated as everyone scrambled to get out, platforms froze up, and the whole thing spiraled into this almost complete loss of confidence. That graph would be a silent testament to the real human cost of unregulated leverage.
Okay, so after such a devastating period, billions gone, reputations ruined, trust totally broken, you'd think people would just steer clear of Bitcoin lending completely.
Logically, yeah.
And yet, here we are, 2025, and lending isn't just back, it's gaining serious traction. Feels kind of counterintuitive. So the big question, why? What's really driving this comeback, despite those, very painful recent memories?
The answer, I think, lies in something really fundamental, a persistent human desire that just didn't go away. The demand for passive income.
Making your money work for you.
Exactly. Investors holding Bitcoin, especially those who see it as long-term digital gold, they still want to make those idle assets productive. They want to generate yield beyond just hoping the price goes up.
Which can be a roller coaster.
Totally unpredictable.
Yeah.
Right. So think about it. If you're holding a good amount of Bitcoin for years, just sitting in cold storage, the natural economic pull is to find ways to make that asset work for you, like stocks earning dividends or bonds earning interest.
Same principle.
It's a really powerful market force, this demand for yield. It persists regardless of past failures, as long as the perceived risk-reward balance shifts, and new models can credibly offer a safer, more transparent way to do it.
And Bitcoin itself is maturing as an asset.
That plays a huge role, too. As Bitcoin gets more adopted, held longer by a wider range of people, individuals, family offices, maybe even some institution, there's this natural evolution. People start wanting utility beyond just HO dealing.
Right, not just a digital piggy bank.
They want to use their Bitcoin actively as a yielding part of their overall financial strategy.
And it's not just individuals anymore, is it? Your sources mention a surge in institutional appetite for Bitcoin liquidity. That feels like a completely new factor compared to before.
Absolutely. This is a monumental shift. What's really fascinating now is this growing institutional interest. It's a significant qualitative change from previous cycles.
Driven by things like the ETF.
Definitely. With the launch of spot Bitcoin ETFs in 2024 and expanding now in 2025, we're seeing billions, maybe eventually trillions, flowing in from a much broader, much more sophisticated investor base.
Big money managers, corporations.
Huge fund managers, corporate treasuries diversifying, pension funds, even traditional investment banks starting to get involved. And these institutions, they need sophisticated tools, not just for buying and holding, but for active management.
Okay, like what?
They need ways to hedge against price swings, generate extra yield on their huge holdings, efficiently manage liquidity across complex portfolios. They're looking at Bitcoin not just as a speculation, but as an asset you can actively manage like they do with commodities or currencies or bonds.
So they need lending markets.
This surging institutional demand for robust, reliable lending and borrowing markets is fundamentally changing things. The demand is growing again, but with a totally different set of needs and much stricter risk tolerances than the retail high-yield chasing we saw before.
So when we talk about ETF liquidity needs 2024-25, it means these big pools of institutional money aren't just sitting there. They need these lending markets for complex strategies.
Exactly. If you're managing a multi-billion-dollar Bitcoin ETF, you can't just let that sit idle. It creates this huge natural need for sophisticated lending and borrowing.
For example?
Well, they might lend out big chunks of their Bitcoin to earn a small, steady yield, adds income, or they might borrow Bitcoin to short it if they think the price will dip temporarily, letting them hedge other positions or play market inefficiencies.
And things like basis trades.
Extensively used. A basis trade basically is about exploiting tiny price differences between Bitcoin's spot price and its futures price. By buying spot and selling futures simultaneously, they lock in a small, almost risk-free profit as those prices eventually meet. All these complex strategies, hedging, yield generation, basis trades, they all require a deep, liquid and reliable lending ecosystem.
Hmm.
The sheer volume and the strategic depth of institutional involvement fundamentally changes the demand side. They're pushing not just for yield, but for way more robust, compliant, and secure infrastructure. It's a game changer.
Okay, so it's clearly not just a blind leap back into the same old risky stuff fueled by hype. New players, even some older ones, are constantly saying they're safer, transparent, and regulated.
You hear it everywhere now.
Are these just buzzwords, designed to make people feel better? Or is there real substance this time? Has the industry actually learned its lesson?
That is the absolute critical question. And we should all be asking it with a healthy dose of skepticism, right? Given what happened. Is this just clever marketing, a rebrand after a disaster? Or has the industry genuinely learned from those massive failures? The promise, and really the necessity, is for a much more mature, responsible, risk-aware ecosystem.
The hope being?
The hope and the expectation from regulators and investors is that the collapse has served as an incredibly harsh, very expensive lesson, prompting a fundamental rebuild of lending protocols and platforms.
Right.
Many of the new or revamped platforms are now explicitly highlighting these three things: safety, transparency, regulation as non-negotiable foundations. They get it. Without genuinely tackling these, trust just can't be rebuilt, especially not with institutional money waiting.
It's not just about the highest yield anymore.
No, it's about offering a credible, secure, compliant way to get yield, even if it's more modest. It suggests a strategic shift away from growth at all costs to sustainability and managing risk.
That's a key difference. Credible, secure yield. And it brings up a question for you, the listener, right now. Would you actually lend your Bitcoin again after Celsius, after BlockFi, knowing what happened? What specific changes, what new assurances would you need to trust these platforms again? That's the core challenge the industry faces.
Okay, one of the biggest problems before was just the opacity, right? You had no idea if platforms really held the assets they said they did.
Total black box sometimes.
Now, we're seeing proof of reserves becoming not just optional, but mandatory for many. So what does that actually mean for the safety of your funds? How does it change the game?
This is a direct, fundamental answer to that lack of transparency. And let's be honest, the fraud that happened last time. Proof of reserves, POR, is basically a verifiable cryptographic audit.
Okay.
It proves a platform holds the customer assets it claims to at a specific moment. It cryptographically shows that the sum of all customer balances matches or is less than the total assets the platform holds in publicly checkable wallets.
And the key part now is the third-party audit. Absolutely crucial for 2025. That adds an essential independent check. It's not just the platform saying, trust us, we have the funds. It's an independent, reputable auditing firm confirming it, often regularly, maybe monthly or quarterly.
That seems like a big deal.
It is. It significantly cuts the risk of fractional reserve stuff, lending out more than they hold, or just outright fraud, claiming Bitcoin that isn't there. Now, POR isn't a complete picture of financial health, doesn't show liabilities.
But it's a start.
It's a vital, concrete step towards rebuilding trust. Verifiable transparency on the asset side.
Right.
It forces accountability that just wasn't there before.
So it's not just a claim, it's verifiable, auditable. That's a huge shift. And if we were tracking proof of reserves adoption, we'd look at who's doing it, how often, and who's doing the auditing, right?
Exactly. That data would be a powerful sign of real commitment to transparency, a move towards accountability.
The frequency, the independence, the reputation of the auditor, those are key tells.
Precisely. A monthly or quarterly audit by a known firm like Mazars or Armanino shows way more accountability than a platform doing it rarely or just saying they did it themselves. It's about being proactively, demonstrably transparent.
Okay, moving to the more technical side, but just as vital. On-chain collateralization. Sounds very DeFi, but it's influencing even hybrid models now. What does that actually mean for someone lending or borrowing? How does it reduce risk?
This is a fundamental architectural change. Big in DeFi, obviously, but now influencing CeFi and hybrid players too. Basically, smart contract-based lending means the whole loan process.
The terms, the collateral.
The terms, the collateral, the rules for margin calls, and critically, liquidation. It's all programmatically enforced and executed automatically on a blockchain.
So it cuts out the middleman.
Dramatically reduces counterparty risk. The risk the other side won't pay up, or a central platform fails or acts badly. If a borrower defaults, say their collateral drops too low,
The smart contract just handled it.
automatically, transparently, irreversibly liquidates the collateral to pay back the lender. No waiting for someone's manual process. No relying on their discretion or good faith. It's all handled by code.
Avoid certainty.
Unprecedented certainty, predictability, efficiency. removes human error and subjective calls from really critical points in the process. It's trustless, trust and audited code, not a fallible company.
That automation sounds super efficient, cuts out a lot of the human error, the potential for fraud that we saw before, but doesn't relying so much on code bring its own risks, like smart contract bugs? We've seen big exploits.
That's a sharp point. Absolutely crucial. While on-chain collateralization cuts counterparty risk, it definitely introduces or magnifies smart contract risk.
Right. Bugs, exploits.
Bugs, coding flaws, sophisticated hacks in the code could lead to unexpected results, frozen funds, or just losing assets entirely. So yeah, you're not eliminating risk, you're shifting it.
From trusting people to trusting code.
Exactly. Instead of trusting a CEO, you trust a developer's code. And code can have bugs, be exploited, even backdoored if not vetted properly. This just highlights how critical, robust, independent, ongoing auditing of the smart contracts is.
So platforms need to invest heavily in security audits.
Heavily. Multiple audits by reputable firms like Certic or Consensus Diligence, bug bounties to get white hat hackers finding flaws, even formal verification to mathematically prove code correctness. It's a trade-off. Swap one risk for another, hoping the new risks are more manageable, auditable, transparently identifiable than opaque human management. A different trust model.
Okay, let's talk regulation. Used to be almost a dirty word in crypto, right? Stifling innovation.
Definitely the old view.
But now it's increasingly seen as necessary. A protector, foundational for stability, and especially for attracting that institutional money. What are these new US and EU laws actually requiring from lending platforms in 2025? How do they change things?
This is a really critical, transformative development. Shows the industry maturing. After the collapses, regulators globally saw the urgent need for clearer rules, better consumer protection, just given the sheer scale of losses.
So what are they demanding?
In 2025, we're seeing concrete US and EU laws taking effect. They demand much clearer custody rules. Who actually owns and controls the assets? Is it the platform or the customer in segregated accounts? This hits directly at that past problem where platforms mixed customer assets with their own.
Treating customer funds like their own balance sheet.
Exactly. Beyond custody, these laws mandate enhanced lending disclosures. Investors must get more comprehensive, standardized, transparent info about the risks, the loan terms, the counterparties involved, and exactly how their assets are being used.
Especially rehypothecation.
Especially if they're being rehypothecated that needs explicit consent now. This isn't about stopping innovation. It's about setting up guardrails, protecting consumers, ensuring market integrity, preventing systemic risks from snowballing again.
Forcing accountability.
Forces platforms to operate with much greater accountability, transparency, consumer protection. Moving away from the Wild West towards a more mature, regulated financial space. The EU's MiCA regulation, for example, is huge. Comprehensive rules across all member states sets a global precedent.
And in the US.
Still a bit fragmented, but we're seeing much more enforcement, clearer guidelines from the SEC, state regulators demanding similar disclosure, and asset segregation.
So it sounds like this big push for transparency is coming from inside the industry with POR and outside with regulation. How do you think this affects global competition between crypto hubs? Are some places becoming better for innovation, others maybe havens for riskier stuff?
That's an excellent point, highly relevant. The different regulatory approaches are creating a competitive dynamic, regulatory arbitrage, people call it.
Right.
Jurisdictions that create clear, balanced rules protecting consumers, fostering trust, but without killing responsible innovation, they'll likely attract more legitimate businesses, institutional money, long-term talent.
And the others?
Regions that stay ambiguous or are too restrictive or maybe too lax, they might see talent leave, innovation dry up, or maybe attract the riskier, less compliant operations looking for loopholes.
Like the EU's MiCA trying to harmonize things.
Exactly. MiCA aims for a single framework across 27 countries. Could position the EU as a leader in regulated crypto, offering a passport for compliant firms. Meanwhile, the U.S. is still finding its way, different agencies, different views, creates uncertainty.
So platforms choose strategically.
Yeah, they're choosing where to set up shop, often favoring places with both regulatory clarity and a supportive environment for innovation. It's a tough balance for governments. Foster tech advance, but safeguard stability in consumers. The outcome shapes where crypto innovation happens globally.
Okay, back to the practical changes. You mentioned those crazy high LTVs, loan-to-value ratios that caused so many liquidations before. Has that fundamentally improved? Are platforms really being more careful, or is high leverage still too tempting?
It's significantly improved. The industry learned an incredibly painful, financially devastating lesson about too much leverage. In 2025, risk controls are way more disciplined, more conservative across the board,
So LTVs are lower?
substantially lower.
Yeah.
Where we saw those dangerous 80–90% LTVs in the 2021–2022 frenzy, today, many reputable platforms, especially those targeting institutions, are running LTVs often in the much safer 50–60% range.
Some even lower.
Yeah, maybe even lower for really volatile assets or less liquid stuff. This creates a much, much bigger buffer against market swings.
So a price drop doesn't automatically trigger chaos.
If Bitcoin drops 10, 20, even 30%, alone with 50% LTV is still well collateralized, far from liquidation, makes platforms way more resilient to sudden drops, drastically cuts the chance of those cascading liquidations that destabilize everything.
And even if liquidations happen,
There's enough collateral to cover the loan without causing systemic stress. This is one of the most practical, immediate, impactful changes addressing a core past vulnerability. Shows a shift towards preserving capital over just aggressive growth.
that's a huge tangible improvement. Tackles a big structural flaw. Easy to picture that difference on a chart, right? The loan-to-value ratios trend, dropping from those reckless 80–90% peaks down to the safer 50–60% range today,
Exactly.
would be a stark visual of this new prudence, a measurable commitment to stability.
Absolutely. That chart would show a clear, measurable move from speculative risk platforms on razor-thin margins to a more cautious, capital-preserving approach. It's the industry really internalizing those hard lessons, acknowledging crypto's volatility, and building better financial firewalls. #tag a fork in the road. CeFi versus DeFi in the new era.
Okay, so the C in CeFi, centralized finance, used to be almost synonymous with risk, thinking back to those collapses. What do CeFi lenders look like today? Have they really changed, or is it just new paint on old models?
Today's CeFi lenders think platforms like Coinbase borrow-type products or institutional ones like Anchorage Digital. They've really undergone a profound change. They are now heavily focused on compliance, risk management, regulation as their absolute foundation.
Operating more like traditional finance.
Much more like traditional financial institutions, yeah, just with crypto assets. Their main focus is strict regulatory adherence, tough capital requirements, and offering services with often limited leverage both to customers and in their own operations.
Less risky internal trading.
Gone are the days of aggressive proprietary trading with customer funds. That was a huge pitfall before. Instead, they often act more like regulated intermediaries, just connecting borrowers and lenders, not doing risky yield farming themselves.
And custody's better.
Robust custody, often qualified custodianship, clear asset segregation, strong auditing trails. This deliberate focus on established financial principles, transparent operations, solid compliance, it's strategic. To regain trust, especially institutional trust, they're betting on safety and regulation as their edge.
Okay, and what about DeFi, the Wild West of crypto? Known for innovation but also risk? Is it more reined in now, more mature, or still the frontier?
Well, DeFi protocols like Aave, Compound, Maker, they still hold true to that core idea of trustless lending, relying on transparent code, smart contracts, not central players.
But they've added safeguards.
Yes, they've integrated a robust set of improved guardrails, risk management strategies addressing past vulnerabilities. We're seeing more sophisticated liquidation bots, ensuring timely, efficient liquidations in volatile markets, preventing bad debt from piling up.
Protecting lenders better.
Right. Many protocols also have strong insurance funds, often community-governed, designed to cover potential protocol defaults, hacks, other black swan events. Adds a crucial protection layer.
And innovative stuff, too.
Yeah, like advanced approaches to real-world asset, RWA, collateralization. Bridging TradFi and DeFi using tangible, off-chain assets, real estate, invoices, carbon credits as collateral for on-chain loans. Opens up huge new liquidity pools.
MakerDAO is a good example.
MakerDAO's sustained growth is a powerful case study. Its transparent, over-collateralized stablecoin, DAI, has built immense trust and stability. By always requiring significantly more crypto collateral than the loan value, it creates a huge buffer against volatility. Proves the model works with prudent management, algorithmic stability. It's not the same Wild West. It's a more organized, though still dynamic frontier.
That sounds like MakerDAO is really focused on resilience through over-collateralization. But you also mentioned platforms like Maple Finance and Avi3 are doing under-collateralized institutional credit. That sounds risky again. How are they managing that? What's risk drenching?
Excellent question, because under-collateralized does sound like it goes against the lessons learned. While over-collateralization is still king for most retail DeFi, platforms like Maple and Avi3 are pushing boundaries for sophisticated institutional needs.
Lending with less than 100% collateral.
Exactly. Lending to reputable, vetted institutions with less than full collateral. More like how traditional banks lend to companies based on creditworthiness.
So how do they manage the risk?
Through highly sophisticated mechanisms, primarily risk tranching. Imagine a big institutional loan sliced into different parts, or tranches.
Okay.
Each tranche has a different risk level and offers a different interest rate. The senior tranches are less risky, get paid back first, offer lower yields appealing to conservative institutions, maybe pension funds.
These are riskier tranches.
Junior or mezzanine tranches are riskier, absorb losses first, but offer much higher potential returns, attract more aggressive capital. This lets different investors with different risk appetites participate in the same loan pool.
How does Maple do it?
Maple vets institutions for creditworthiness, then pools lender money into lending pools with specific risk rules.
And I've.
Of V3, with its super detailed risk parameters for specific assets or pools, allows fine-grained control over LTVs, liquidation thresholds, interest rates. Makes it possible to manage these complex institutional loans with high transparency and programmability using DeFi's automation. It's not a free-for-all. It's structured, capital-efficient, transparent, credit-bridging TradFi practices with DeFi execution.
It sounds like these two worlds, CeFi and DeFi, once seen as almost opposites, rivals even,
Ideological rivals, yeah.
they're now starting to borrow heavily intelligently from each other, finding common ground.
Precisely. If we connect this to the bigger picture, the lines are definitely blurring. Shows a maturation beyond those early divides. We're now seeing sophisticated hybrid models emerge,
Combining the best of both.
deliberately trying to combine the best attributes, the robust regulatory oversight, compliance focus, institutional-grade custody from new CeFi, merged with the on-chain transparency, automated execution, censorship resistance of DeFi.
Like what specifically?
Think of a platform offering regulated custody KYC/ML checks, but then deploying those assets into audited, over-collateralized DeFi protocols via smart contracts, with all terms viewable on-chain.
Interesting.
This synthesis could well be the most sustainable, scalable future for crypto lending. A model offering security and compliance for institutions alongside innovation and efficiency from DeFi. It's exciting, complex, suggests a more integrated future for crypto finance.
Yeah, it really is. And it brings up another key question for you, the listener. After all this, do you trust DeFi lending more than centralized lending now with its new rules? Or maybe you still avoid both? What makes you lean one way or the other in this new landscape?
Yeah. Where do you place your trust?
And if we looked at a CeFi versus DeFi market share chart, it'd be fascinating to see who's really winning capital post-collapse. Or if these hybrid models are truly gaining traction, that would give us a real pulse on investor confidence.
Exactly. Market share dynamics show where the capital is flowing, where trust is being placed, which models resonate most with retail and institutions. It's the ultimate vote of confidence.
Okay, so after all this evolution, the painful lessons, the innovations, what does it all really mean? Why does this Bitcoin lending resurgence matter so much? For the average person or for Bitcoin's future role itself, this isn't just about earning a bit extra, is it?
No, it's far more profound. This shift is huge. It could fundamentally drive Bitcoin's utility beyond just being digital gold.
Beyond just the store of value.
Right, beyond something you just hold, maybe as an inflation hedge. This resurgence of more regulated, transparent, secure lending effectively turns Bitcoin into productive capital.
Meaning,
Instead of just passively holding it, you can now, hopefully safely and verifiably, deploy it, earn yield, provide liquidity for complex finance, even fund new ventures globally.
makes it more versatile.
It radically enhances its functionality, makes it a more versatile, integrated, active asset in the global financial system. It moves Bitcoin from mainly speculative or a hedge towards being a foundational financial primitive.
Like traditional capital.
An asset actively used to create more value, like real estate or bonds. This opens up entirely new valuation models, new use cases, potentially embeds Bitcoin much deeper into global commerce and finance.
That's a powerful vision, Bitcoin as productive capital, but there's always the ghost of collapses past, right? Even with all these improvements, is this truly sustainable, or are we just setting up for another boom and bust, maybe just with fancier mechanisms this time?
This raises that important, really challenging question. It's the critical test for the whole crypto ecosystem right now. This comeback is pivotal.
Can it actually work long-term?
Can crypto lending truly exist sustainably, responsibly, without that inherent fragility?
Yeah.
Or is it always going to be a ticking time bomb? Susceptible to the next downturn, some unforeseen black swan, or just human greed and error? The The industry is trying hard to prove lessons were learned, that the new guardrails, tech, and regulatory are robust. But the inherent volatility of crypto, plus the potential for human error, misjudgment, bad actors, it means vigilance is still absolutely key.
The risk is still there.
The risk of another liquidity crunch, if history repeats, maybe in a new way, remains tangible, ever present. The global 2047 nature means risks spread fast. The industry's improved, yes, but risk-free in crypto lending. Still an oxymoron.
It's that constant tension, isn't it? Innovation versus risk. And speaking of value and risk, for you, the listener, what do you think is a fair yield for lending Bitcoin today? 3%, 8%, 15%?
Your answer probably reveals a lot about your own risk perception.
Right, your perception of the true risk, even with the safeguards. Could Bitcoin lending ever be as safe as, say, a traditional savings account, a government bond? Or is that impossible given crypto's nature?
A fundamental question.
If we looked at a hypothetical BTC yield curve 2025, compared what lenders offer now versus traditional bond yields, that would give a fascinating insight into the market's collective view on risk and return.
That comparison is absolutely crucial. A much higher yield on Bitcoin lending versus a traditional bond, which is often the case, tells you the market still prices in substantial risk, even with the new safeguards.
Reflects the volatility.
It's a direct reflection of that inherent volatility, the ongoing regulatory uncertainty in places, the lingering questions about long-term sustainability. It's the yield that compensates for those extra layers of complexity and potential downside.
Yeah.
Hashtag outro.
So as we've seen, the journey of Bitcoin lending, it's been an absolute roller coaster. Breathtaking highs fueled by crazy demand, then devastating lows that shook the whole system.
Whiplash, really.
But what stands out to me today is the sheer resilience, the adaptability of this crypto space. The new models we've talked about, mandatory poorer, on-chain collateralization, tighter risk controls, the regulatory push-it-all, suggests a maturing ecosystem.
Trying to learn from mistakes.
Genuinely seems like it, trying to learn from its most painful mistakes. However, the fundamental risks. Volatility, smart contract bugs, human error, maybe bad actors. They'll likely always linger, right?
Seems probable.
So what does this all mean for your approach listening now to Bitcoin and digital assets moving forward?
Ultimately, the core question for you, the learner, is whether the industry has truly built strong enough defenses to handle the next storm, whatever that looks like.
Are the new guardrails enough?
Are they really sufficient, offering genuine, verifiable protection? Or is that allure of high yields still too strong for some to resist over-leveraging or cutting corners again? The future of Bitcoin lending won't just depend on cool tech and clever protocols. Critically, it depends on consistent, disciplined risk management, transparent practices across the board, and strong, clear regulatory enforcement. It forces all of us to really assess that delicate balance, that constant push and pull between innovation and stability.
Well said. If this deep dive into Bitcoin lending's comeback gave you clarity on what's genuinely new, what risks are still out there, and how Bitcoin itself is evolving,
Hopefully it did.
then make sure you like this video, subscribe to our channel, and definitely hit that notification bell. Your engagement, subscribing, commenting, and sharing it really helps the deep dive keep going.
It genuinely makes a difference.
Yeah, it boosts our visibility in the algorithm, lets us keep creating quality, in-depth crypto content for our dedicated and curious listeners. We seriously couldn't do it without your support.